Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to do velocity banking with student loans. In fact, this is a relatively easy situation to cover. Like if you have one or two loans and you're doing velocity banking, it's not really that big of a deal compared to the things that I've seen. So there are a lot of people out there, especially six-figure earners, who email me from time to time. And if you have one or two debts, this is a relatively simple situation. But take a look at this. I have people emailing me their information, and they got debts like this. So for example, this one guy, six-figure earner, I think he makes like 7 grand a month net, which is or 7,500 a month net, which is a really good salary, and has 14 debts, right? Credit cards, loans, HELOCs, and has payments of $4,000 a month, right? And the reason why I talk about like this is not that complicated is because this is where what we're trying to prevent when doing velocity banking, and the phenomenon that we're trying to prevent is called segregation of income. Okay, so if you don't know what segregation of income is, it just means that when your paycheck comes to your checking account, your income isn't split all over the place. So you can imagine if you have 14 debts, your income is split all over the place. Thus, you're making minimum payments on every single one of them, and it seems like the interest is just not, or the principal balances of these debts are just not going down. Now, that's different, and what we're trying to prevent with velocity banking, where we try to put one paycheck into the line of credit, right, and then pay off our debts and increase our cash flow. Now, just before I actually get into the topic itself, why did I choose this topic? It's actually because YouTube analytics told me that people were looking for this. So, just this week and possibly next week, I'm just going to look at whatever people are searching for and then just make a video about it. Velocity banking with student loans. Student loans, auto loans, loans in general, amortized loans, they're all the same, right? I think people somehow think that a student loan might be different from auto loan just because of name, but it's all the same. It's probably a period of couple years. The only difference is that unfortunately in this country, we kind of scam young people into getting college degrees. Like I'm not gonna sugarcoat it, and we don't educate them. I think I heard that the student loan is like the number one asset of the federal government, and that's probably why that they don't let you declare bankruptcy on them, right? So this is like the only loan where they don't underwrite you and declare bankruptcy, and they just burden the young generation with debt. I mean, it's really insane. But as for paying off student loans with velocity banking, it's relatively easy, okay? So what we're going to do is review what are the two requirements for velocity banking. So the first one is a budget, right? So I kind of half did that, right? And the second one is we're going to have a line of credit as our operating account, and let's just assume that we have a 15% personal line of credit at a $10,000 limit, right? And again, some of you might be thinking $10,000, that's a lot. It depends, right? And I showed this in another video. Well, let me actually show my community feed or the community feed of this channel. You kind of see that just yesterday I got a new $24,000 credit card, which is a line of credit, right? $24,000, boom, for a rental business that I have. Okay, so again, these days, $10,000 isn't that much to me. And if you understand credit, what the banks are looking for, and you build relationships with banks, which is not that hard. I mean, it's not like you're building a personal relationship. It's just you having an account, making payments, using their products, right? They're more likely to lend you money. I don't guarantee anything, but they'll be able to lend you this. Now, um, before we actually get into the strategy, let's just kind of review our default option as the average American. And let's discuss this. What's the difference between the average American and someone who does velocity banking? The average American pays their income, or not the income, their expenses out of their checking account. Whereas someone who does velocity banking uses their line of credit as their main operating account if they have debt. Like if you don't have debt, you don't need a velocity banking at all, right? Because it's a debt payoff strategy, okay? But for this person here, let's say that we're not using our line of credit as our main operating account and paying things with our checking. So if we have all of this, right, and we have 1,300 savings, which is actually pretty good. Let's just assume this is a college graduate who got a $5,500 a month job, which is a really good salary, to be honest. But instead, if let's say I didn't make that much money, then I might sacrifice on the rent and expenses and live at home with the parents so that I could, survive. Because, if you don't make enough income, guess what? You're gonna have to do one of two things: get roommates, or you just live at home, right? Because landlords won't rent to you unless you make three times the income, or three times the rent as income, right? I don't know if you're aware of that. But let's just assume here we got a good job, we have two student loans, and again, very simple situation because we don't have two debts. We're not 14 debts in and experiencing segregation of income, but we do have options here even without velocity banking. So what are our options? I could just use this savings to just overpay my loans. This is kind of like the option everybody knows that they have inside their head. Like, you don't have to teach anybody that. But why is it that most people will not do that? Like, let's say like I dump this 13 whatever, right? And dump it all into my student loans or whatever, along with these payments. Why would I not do that? The reason that I know from my own personal experience I wouldn't do that is because if I overpay it, what if I need like extra 10, 20, $100, right? Like what? Like, again, the reason why it's hard to overpay loans directly is because you lose that liquidity, right? That's why these interest rates are lower, and I'm actually going to get into more explanation on this. So let's actually ask ourselves, why is it that a line of credit interest is higher than loan interest, right? Like, why is it that this is 6%, right? Whereas a line of credit is 15%, or personal line credit, and credit cards go high as like 30%. Why is that? Right? Because what interest equals, right? So higher interest equals more access to money, right? I hope that makes sense, right? So let's say like you get a $30,000 loan. If I pay that back, I'm never allowed to get it again unless I like refinance that loan. You see what I'm saying? And if you ever done refinancing, it is expensive, especially like home refinances. You just pay up the wazoo just to get them to originate the loan. Um, Now with the line of credit, yes, the interest rate is higher, but the reason why it's higher because it's priced so that if they give you more access, right, they have to charge more. Hope that makes sense, right? So higher interest equals more access to money. Now, people just see numbers, they say, oh, 6%, good because it's lower, and 15% bad because it's higher, rather understanding like this is the appropriate tool at the appropriate moment. And so if we need immediate access to our cash that we've repaid back to our line of credit or credit card, it's okay that we have to deal with higher interest rates, right? Because if I deal with only loans, right, and you can, again, no, loans are not bad, lines of credit are not always good. For example, let's say like if I'm gonna buy a real estate deal and it's $1 million, and I could get an $800,000 loan at 3%, I definitely would get that, right? $800,000 loan at 3%, and maybe like a $50,000, like 15% line of credit. Okay. But it doesn't mean that loans are completely bad. Just be aware that the reason why they are lower interest is because they've cut off the access to that money, so they know that they'll still make money off of you without you know without giving you, because they know that you're just only going to make minimum payments over time. It's like a psychological thing, as it is. It's just that's the nature of the product. A loan is a one-way street compared to a line of credit, and if they have to give you two-way access, well, guess what? They'll charge you 9% more. And if you just look at it objectively, okay, that makes sense, right? So the only reason why that line of credit interest is higher than the loan interest is that the higher interest just means more access to money. Okay. Now, another thing, so what if we did not want to use a line of credit? Again, we can make extra payments. I can put this 13 grand, or not grand, $1,300 into and overpay it into student loan one or student loan two. And it's going to pay off really fast. Absolutely, right? You're going to pay this off really fast. But if you ever needed this money in an emergency, so let's say I put this 1300 in loan one for whatever reason, and then I had a $1,000 car emergency, can I ever get that money back? No, they're not going to let you because of that low interest rate. That's the product is the product, right? there's a reason why it's a low interest rate, because it's going to be a fixed payment over time. And if you overpay it, you never get that money back. Everybody has this option. I had this option while I was paying my student loans, and I never, even thought about overpaying, just because I was so afraid. Like, well, if I overpay it, what happens in case I have emergencies, right? So again, another way that we can do it is through velocity banking, where we use our line of credit as our main operating account. And so in this example, we're just going to pay off $35,000 of debt using the line of credit, right? Okay, so if you ever have loans, right? And let's say like the loans are higher, let's say they're higher balances than the limits of the line of credit, and they're lower interest, right? One of the things that you might consider is just doing something called chunking. One of the things, because this balance of student loan two is $5,000, right? I might want to pay that one off first, just so I can get $96,000 of cash flow. Okay. There's a lot of ways to figure out what debts to pay, and I'm just going to go over a quick review. Let me just do this. Debt payoff criteria. And I know we only have two loans, so I hope I'm not overcomplicating it with just two loans. So the first way to determine what debt to pay off first, whether you're paying off student one loan or student two, is you want the lowest balance, highest interest rate, and highest payment, right? And so student loan one has the highest, it doesn't have the highest interest rate, but it has the highest payment, right? But we can't eliminate it because it doesn't fit within the $10,000 line of credit. Okay. Student loan two, again, it has the lowest balance, but it has the same interest rate as student loan one, and it has the lowest payment. But I might want to eliminate student loan two first, just because the balance is relatively low. Another thing that I might want to consider is called the cash flow index, which ignores the interest rate. So that is just a statement balance divided by the monthly payment. And I think because these two loans have the same term and interest rate, they're actually going to be the same. But let's go ahead and calculate it. So 30,000 divided by 579.98, right? And then this one is 5,000 divided by 96.66, okay? And then as you can see here, these cash flow index numbers are exactly the same. So usually what it is, I kind of consider this to be like a ranking system. Would you always want to pay off the one that's lower, because you get more bang for your buck in terms of cash flow? Um, and actually, if I recall correctly from Garrett Gunderson's website, the Will Factor kind of created this formula. Basically, you want to pay off anything under 50. So this is kind of like right at that 50 mark. So again, there's different ways to evaluate which ones to pay off. This is what I'll do. I'll pay this one off first, right? So again, so let's go back here to this question. Why not just extra payments? Extra payments equals loss of liquidity, even though, what do you call it? Even though you pay off loan quickly, right? So if every time you're putting your savings in, it goes to zero and you have an emergency, oh my goodness, I lost control of my money, right? So again, that higher interest rate just signifies that you just have, even if they charge, like it costs more, right? You'll be able to sleep at night. I hope that makes sense. Okay. So let's go ahead and delete these, and I'm just going to go ahead and show you the lines of credit. So I'm going to go ahead and delete these columns. Okay, so let's just do this. And what we're going to do is we're going to pay off, or just do a debt transfer of the student loan of $5,000 balance. Okay. And this is month one. And then now let's go ahead, since this is paid off, right? Student loan two is paid off. Now this is going to be zero. Okay. And what's our new cash flow? So equals C, it's not going to be that much. C2 minus C3 is 1420.02. So now what we can do is just keep just subtracting our cash flow from the balance, right? So it'd be G2 minus, or actually plus the interest of the previous month's balance, which would be H2 minus 1420 point, oh, sorry, 20.02, right? And again, there's no interest here because we don't get the interest until it's calculated in the first month statement. But if you want to calculate the interest the first month, what you do is you take the average daily balance, right? So we have average right here, right there, multiply it by the interest rate, which is 0.15, and then divide by 12. Okay, so we pay $50, and then let's just repeat this a couple of times. Okay, so after 4 months, we pay it off this 5K. Okay, and let's put some milestones here. Some milestones. And at this point, if we had an emergency, we always have this buffer up to 10K, right? So even when we do this in our first month, let's say we did have that $1,000 emergency, okay, then it's just going to delay our payoff by like a month or two, right? So no need to worry about that. Whereas if we directly overpaid the loan, which everybody has the option to do, I remember when I had student loans, I was always afraid to overpay them because I didn't make that much money, and I think it's criminal that in society we actually burden our young people with so much debt without any real life skills, right? And if I ever needed that money in emergency, then I'd be like, oh my goodness, like I'm not going to overpay my loans. No, thank you. But if I had a system like this, yeah, definitely. I definitely would. Okay. So, because again, it would, no matter what point in the process, right? If, what's it called? If I needed, extra emergency money, I just get it from here. I'll delay the payoff. Now, ideally, you don't want to because again, they're charging that 15% interest rate, but whatever. That's like I said before, higher interest equals just more access to cash. So, if you want to live this incredibly disciplined life where you overpay the loans, but you can't go anything extra, then go for it. All right, so now let's just go ahead and do this. So let's say, how many months was it? Month four. Okay. So now it's 4 months to pay off 5K. Not bad. Okay. And then now we have 30K here. So let's see after 4 months, right, what the student loan balance is. So did I do this? No, I haven't done it yet. So this will be $30,000. Okay. So $30,000. And let's just calculate it, show the amortization schedule. If you ever want to check it out, just type bank rate student loan calculator on Google, right? And then let's just go to, did we say 4 months? Yeah, I have bad memory. 4 months. Okay. One, two, three, four. And so now our balance, our principal balance is 28K, right? So, okay. So now basically, at this point, you're just going to do something called chunking. So there's a really big difference between paying off, let's say, a low interest loan that has a high balance versus like higher interest rate um, credit card debts, right? Like if you have like really high interest credit card debts or something that has a very low, and let me go back here, cash flow index and it's a loan, then just move it to the line of credit. But if it's, again, let me actually recalculate the cash flow index for this one at this point. So equals 28267.12 divided by 12. Oh, did I screw up? 287 divided by 579.98. It's 48, so I think you can, if you have enough in the line of credit, I think it'll be acceptable to pay off, but we only have $10,000, right? So we'll just do something called chunks, and then we'll just put 5,500 chunks, move it from the loan to the line of credit. So what we can do is just minus 5,500 here and move it here. Again, this is going to be a little bit inaccurate just because you actually make payments while um, paying off the line of credit to the student loan. And it's at the payoff time is actually probably going to be a little bit faster than I'm calculating right now, but I'm doing cowboy math. So 5500. Okay. So now what we do here is we add 5500. Okay. And let's do this. Let me highlight every time we do a little chunk, right? So that we don't forget our place. And then now the balance right now is 22,767.12, right? That's our balance right now. And then what we do in the next line is just keep going until this goes to zero. So minus 1402.02. All right, and then I want to take away the highlight, no fill, and we'll make this black. Okay, so now let's go ahead and do this, and right, so 5, 6, 7, 8. No, whoopsie, 5, 6, 7, 8. Right. So at 8 months, we just kind of do it again, right? And again, after 8 months, this will not be 22 grand, but let's just assume it is. Make the math easy on ourselves, and then we'll just subtract another 5,500, and that would be 17, 267.12, right? And then you just kind of rinse and repeat over and over again. Again, the whole point of this is that so you can easily, pay off the principal and prevent segregation of income, because what you don't want to do, the reason why I really think velocity banking is so effective is because if you have your money in just one place and you're concentrating in one place, you're going to prevent this situation. And I always say segregation of income is the reason why six-figure people are broke. Now, if you don't have any money, right? You graduated college, no job, and you have student loans to pay. Uh, Tough on you, right? Because that's society's fault, to be honest. But the velocity banking strategy is not an income generation strategy, and I think that's where people get it wrong. It's a cash flow management strategy. Okay, so all right, so now let's go ahead and so we did one chunk here, right, at this point, and then now we got to just do another chunk here. So this will be uh, plus, actually, let me do this to make it easier. So plus 5,500, okay? And let me go ahead and highlight and red this and okay. And then, yeah, so we just keep going. So now this is one chunk, this is two chunk, and then we just keep going until we get that red again, okay? And now I subtract another 5,500, right? Minus 5,500, 11. So we're almost there, right? So this will be 11,767.12. And let's go ahead and do this. All right, so plus 5,500. Okay. And let me highlight this right here. 9, 10, 11, 12, 13, 14, 15, 16. And then what's the amount right now? Minus 5,500. Again, this is inaccurate because we're moving to line of credit, and we're still making payments to the what's it called, the student loan. And this is all cowboy math. So 6267.12, right? So, whoopsie. Okay, so this will be, I'm going to add 5,500 here. And let me go highlight this. And you know what? Even at this point, we could probably add the whole because we all right. So we're at 6,000 balance, right? Can we add the whole thing? No, let's just keep going one more time, and then we'll get to red, and then we'll just put the whole thing after this chunk. Whoopsie. Oh, my keyboard's going crazy. Oh well. All right. So 17, 18, 19, and then at this point, we're gonna put 6267.12 here. Now what happens, 6267.12. So when we do that, right, guess what happens? Loans paid off, student loan is paid off. This is going to be zero, right? And now we have a $2,000 cash flow, okay? So now this is going to be minus 2000. Okay. And then, right. And so now this is 20, 21, 22, 23, right? So 23 months to pay off. Uh, so this is started with our 5,000, right? And then we made how many chunks? One, two, three, four, four. No, four, five. Okay. So one, two, three, four, five. And again, the reason, again, you have two options, right? You could just directly put your savings into the student loan, or you can just pay, the interest rate is 15%, but you just have access to your cash all the time and have one place to put your paycheck. And that's why I say, like, this strategy, when you have one or two loans, is not really that complicated. I think people overthink it. But when you have lots of debts like this, then you might have to be a little bit more strategic, right? You think about the payment to the balance, cash flow index, the interest rate. Um, and so here, let's just look how long it took us. Okay. So 23 months to pay off. So let's just do here 23 months to pay off how much of debt? 35K of debt, right? And so now, what's 23 months? That's a little bit less than under 2 years. So equals 23 divided by 12. Yeah, it's right under that 2 year mark to pay off 35K of of debt, right? So not bad. I mean, probably could do a little bit better, but what I'm saying is that you're not going to wait 5 years to pay these student loans off. And what's funny is that people are desperate for like student loan, I guess, deferment and relief because they're broke, right? And what happens when you do student loan deferment is that interest just keeps accruing because you're not making any payments, right? So whenever they do student loan forgiveness, I think what happens is because like, and you'd have to like, investigate for me because I don't know for sure. But what I heard is that because you don't make payments, the balance accrues over time, and then when they actually forgive it, it actually becomes taxable income. I think, again, check with the CPA accountant. I am not a CPA accountant, not giving financial advice, but you probably do want to pay it off and not just wait for the government to quote forgive them. And here's the thing: I actually agree with Dave Ramsey. If you borrowed that money, you really should pay it back. And I think that's really irresponsible of like the federal government or colleges of just saddling young people with debt without like actually educating them about how debt and taxes work, right? Like, it's insane that we do that, but yeah. All right. So yeah, so this is pretty much it. Like I said before, um, it's just you're doing what we call chunking. The chunk amount, I always say just make it the same as your income and then use your cash flow just to pay it down and just repeat the process over and over again. And you'll be making, payments to the loan while you're making payments to the line of credit because why? Everything is taken from the line of credit, right? And the line of credit is just like borrowed cash, really, because when you go to the bank's website, you click a button and then you have cash in your checking account, unlike a credit card, right? A credit card, you can't pay a credit card alone with a credit card unless you use like a service like Plastique, and you can't pay a credit card with another credit card. So have all the tools available at your ready, right? Okay, so this is Korean Atlanta Mentorship. We just paid off two student loans, relative simple situation, but it may be in another video. I might go over this behemoth, right? And just make up 15 loans and lines of credit and a HELOC. And a lot of people think, oh, a HELOC is velocity banking, right? No, 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 no. A HELOC as your main operating account is velocity banking. As you can see here, because we're not using our HELOC as our main operating account, that's why we have this huge balance and it's up to the limit along with these other debts. Okay, well, that's it for today. I'll try to crank out more videos today. It's a beautiful Sunday. Have a great day, and we will speak next time. And also, plug for the group. If you're interested in joining our group, go ahead and click the Google form link below, and we'll get on one-on-one Zoom call. Other than that, we'll speak to you soon.